Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. Equity markets across the APAC are mixed after an upbeat session in the States. We had U.S. energy and defense shares trading higher after the ouster of Venezuelan President Nicholas Maduro. Now, Chevron is the only super major oil company still operating in Venezuela. Today, its shares were up 5%, which helped to lead the Dow to a fresh record high. Later in the day, President Trump suggested the U.S. may subsidize efforts by energy companies to rebuild Venezuela's oil industry. We got some perspective from Bloomberg's Stapczynski. He spoke with Bloomberg TV host Paul Allen and Avril Hong.
We're definitely in a wait-and-see situation. There are two ways you could play what's been happening in Venezuela. One is it's bullish for prices because it injects geopolitical risk. It could reduce production in the country, or it could also add some risk to maybe the U.S. hitting other countries that are oil producers. There's been a lot of chatter on Twitter and other social media about what's happening in Iran, what's happening in other countries. So that could be something that the market looks at. They're kind of hedging that risk there. The other way you look at it is this clears the way for the U.S. to remove their sanctions and their blockade, essentially, on the shadow fleet ships and on the exports of sanctioned crude out of Venezuela. That would add more supply into the market. But then when you take a zoom out and you look at this in a really macro view, Venezuela is really not that big in the grand scheme of things. They produce less than 1% of global oil supply. While they do have vast reserves, it isn't clear whether or not Trump will be able to convince the Chevrons, the Exxons, those folks into investing in the country, the tens of billions of dollars that's required to really pump up that production.
Yeah, Stephen, tell us a little bit more about that. What sort of investment would be required? What sort of time frame would it happen over? And critically, I guess, what sort of security guarantees would there need to be?
Well, so when you speak to the analysts, you get all sorts of numbers, but I think the general view is that it's going to take about $10 billion per year over the next decade to get Venezuela back to where it was producing in the past. Now, to give you some context, Venezuela produces about 800,000 barrels per day of oil. Now, when you look at the early 2000s, it was closer to 3 million barrels per day. And when you look at the 70s, it was 4 million barrels per day. So when Trump is talking about reviving this oil production, he's looking more at 3 million barrels. That's a more than tripling of production where we are right now. The reason why production has come down so much over the last 2 decades or so is because there hasn't been investment in infrastructure. It's because the country has been dealing with corruption, and also the sanctions have reduced a lot of the output as well, and customers requiring the fuel, and that reduced the amount of rigs on the ground as well. So to get us back up there, it's going to cost billions of dollars, and it's also going to take essentially a decade to get back here. Now, President Trump said on NBC earlier today that he's looking at getting this up and running, whatever that were to mean, in 18 months, which is really against what the view of analysts in the market says, which is going to take quite a bit longer.
That is Bloomberg's Stapczynski. We turn to technology next, and the CES conference. It officially gets underway Tuesday in Las Vegas. Today, Nvidia CEO Jensen Huang announced a group of AI models and tools designed to speed up development of autonomous vehicles. Huang said the aim is to help create vehicles that can think their way out of unexpected situations, such as a traffic light outage. Here is Huang.
Today, we're announcing Alpamayo, the world's first thinking, reasoning autonomous vehicle AI. Alpamayo is trained end to end, literally from camera in to actuation out.
That is Nvidia CEO Jensen Huang. Now, Bloomberg's Annabelle Droulers is at CES. She spoke with Bloomberg TV host Paul Allen and Avril Hong.
Really, one of the biggest announcements he had was around this Rubin architecture. It's essentially the successor to Blackwell. It's a lot more powerful. It can do a lot more with a lot less energy demands as well. So you're getting a bit of a nod to that. Essentially, he's saying that the production has started. They're going to be ramping that up into the end of 2026. And it has been something designed demand specifically for gigawatt AI factories. Now, gigawatt AI factories, you're essentially talking as well about what he addressed during that presentation, which is that AI is becoming a lot more complex, and so as a result it needs a lot more compute power, and that's what he's saying, that they're basically preparing these products to address that need. It's interesting, as we ended 2025, we were talking still a lot about those AI bubbles. He didn't address that specifically in the presentation, but I think he did nod to it when he talked about the demand that he's seeing and how essentially the entire computing industry is changing, and that is driving this big shift in R&D budgets as well from companies across a range of different industries. So essentially saying Nvidia is at the center of the AI ecosystem, and again, that demand is very much still there for the company. But interesting to note, of course, Jensen Huang is still talking about these products a lot earlier in the year than he would typically do.
Belle, Jensen Huang was also speaking about autonomous driving. What did he have to say about that?
Yeah, it was a really big focus as well in the earlier part of the presentation, more on that sort of embodied AI or physical AI, and to that end, automotive certainly were a big part. So he's announced what's called the Alpamayo models. So he's saying that this is the world's first reasoning autonomous vehicle AI. So I don't want to get too technical on it, but what he's saying is essentially it's solving for the so-called long tail, which is when you're out in the world, you're driving your vehicle, and you come across very messy or unpredictable situations. And so far he's saying that the autonomous driving software technology hasn't really been able to solve for that, but he's saying that Alpamayo will have those capabilities. It'll be able to stop, reason with more human-like capabilities, and then make a decision, and that's what he's saying is going to be the really big difference.
This event that you're at, of course, Belle, is really one of the ones where the biggest names in tech gather. What else are you looking forward to at the event?
Yeah, well, it's the biggest names, and then it's also the names that maybe you haven't heard of before as well, because there's all sorts of innovations that we're expecting to see on display. And I think just thinking about mobility, for instance, that's going to be one of the big focus points of the event. And just behind me is actually a product that I've never seen before, which is a motorcycle with two wheels in the front, one in the back. So that's a reverse trike or a tadpole trike. But what is interesting about it is that it's also an eVTOL or an electric vehicle takeoff and landing vehicle. So expecting to see lots of different innovations on display in the mobility space, but also humanoid service robots. They're going to continue to be key. Announcements around digital health, longevity, energy demands as well, because there's that big question how you're going to meet the power needs of AI and computing. So solutions in solar, wind, small nuclear reactors, for instance, next generation batteries. But then also this move to the edge, which we've been talking about for quite a while now, but should be a big focus of CES this year, this so-called AI everywhere or edge AI, which is when you have a lot of that sensitive data that ends up being processed locally. And again, just going back to Jensen Huang, he actually did announce or nod to this in his presentation, because he was talking about agentic AI technologies that are going to become a lot more customized. And again, that points to the need for edge AI.
That is Bloomberg's Annabelle Droulers from the CES conference in Las Vegas, here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. We are well aware of the number of forces working on markets these days. There are obvious geopolitical risks, especially those associated with Venezuelan oil after the U.S. ouster of President Nicholas Maduro. There are also questions surrounding the durability of the AI trade. And let's not forget the outlook for central bank policy, chiefly from the Fed. For a closer look, I'm joined by Andrew Skatoff. He is the founder and CIO at Bancreek Capital Advisors. Andrew is on the line from Los Angeles. Thanks for being here. So I highlighted many of the factors, and given all of these influences, how do you go about separating signal from noise?
You know, when you think back to 2023 to 2024, we did see a fairly narrow rally in the market, and that kind of broadened out a bit in 2025 with kind of the AI infrastructure stock theme durability being surprisingly strong as the current administration kind of increased support of the tech sector after kind of witnessing the impact their initial tariff policies said earlier in the year were having. But we're still seeing a pretty concentrated market, right? And I think, you know, some investors may not fully appreciate the kind of concentration risks that many portfolios still have today, which again, as we move into 26, we actually think there's more of a dispersion that will be present, and think it could set up well for stock pickers. So, you know, when you're asking about like, what does that look like for assessing noise and signal. What we tend to do is a very data-focused approach where we're looking both fundamentally under the hood for these businesses, as well as some quantitative features that we've developed to help us assess what businesses are structurally advantaged and will have the ability to compound capital for investors over time.
Is the concentration risk solely big cap tech?
Yeah, I mean, obviously a lot of people have covered this, but when you look back historically, we're just in a position that we've never seen before, where you have a handful of positions not only being the lion's share of some indices, but also generating for sure over the lion's share of the returns over those specific years. And I think the risk is, or the surprise could be, as you look out in 26 and 27, even if those returns are muted or slightly lower, folks could be surprised that the overall returns of the market will be lower because they're they have such a dominant share and positioning. That's the opportunity, we believe, for active management and individual stock picking.
One of the things that the market is betting on is a lot more in the way of rate cuts from the Fed. And I'm trying to understand whether you would categorize the debate at the Fed and a lot of market speculation more as signal or noise.
A little bit of both, right? Because the Fed has been more accommodating with respect to rate reductions, and we think that will continue to help kind of broader equity markets in general. Though at current valuations, investors need to be mindful of where to allocate capital. And that is where, it's really important to search for the signals. I always talk about if you have like two assets and they both, let's say compound at 10% over a period of time, one asset is 10% every year, and the other asset is kind of all over the place, up 40, down 30, up 20, but you end up kind of in the same place. Is there a difference between the two? And we would say absolutely, because the signal that you're getting from the first asset is telling you there's something structurally advantaged and consistent about that asset's ability to generate return for shareholders. The other asset obviously has a much more volatile path, which tells you there could be increased competition. It could be a more cyclical business environment that they're operating in, but there's potential disruption for that asset. And that's really kind of what we're focused on. And so when you think about kind of the AI and infrastructure play going forward, we do think there are really interesting ways to play it. And so when you look at some of the positions that we own within our ETFs, you'll find businesses that have been around for 100 or so years, kind of old line industrials that will be participating in data center build outs. Just not from like the initial tech stack.
So today, the Russell 2000 was up about 1.6% today. How does your work view the small cap space right now?
It's funny. Small caps, obviously, from when I started my career like 20 years ago, it's very different today, and obviously much larger. So there are some small to mid cap companies that have kind of achieve this escape velocity where they may have started as a really niche market, but have grown and are now scalable and what I would call structurally advantaged. So there are some very interesting opportunities kind of in that, let's say, billion to $5 billion market cap range, where you can find these kind of durable compounders, if you will, that are positioned and set up quite nicely and with multiples that are fairly reasonable.
Well, you mentioned multiples there. One of the criticisms of the equity market stateside has been that, by and large, it's still very expensive, particularly given the AI trade. I'm wondering whether or not it's forced you to look offshore these days, and if so, what are you finding internationally?
Yes, so another great point. For sure, the U.S. market valuation landscape is a little more stretched than we would like, and so we do have international portfolio as well. And what we found historically is that it's traded at a pretty steep discount to the U.S. markets, and you're still seeing some of that discount. But similar type themes, the same durable compounding types of companies. For instance, you might have like a company like a ABB in Switzerland that is a super interesting leader in electrification and automation, and they're going to benefit from kind of the infrastructure spend for data center build out. And I look at this as kind of like an added tailwind to what is already a very stable, well-positioned business. You could also look at companies like BAE Systems, right? So obviously one of the largest defense and aerospace companies in the world, given what's going on internationally these days, you are seeing Europe and other allies outside of the U.S. looking to work more closely with non-U.S. defense contractors to procure, weapon systems and improve their defense capabilities, probably now more than ever. And just given the long-term nature of these contracts, the defense contractors can form really deep customer relationships. I look back at how well some of the U.S. defense companies like Lockheed Martin and Northrop and General Dynamics have performed over the last few decades. And, we think BAE will have a meaningful long-term runway from here.
One of the areas of strength today in the U.S. equity market was financials. How are you viewing the financial industry right now?
So financials have been pretty volatile over time. So again, our perspective is you want to get paid for, incremental, unit of volatility or risk that you're taking as an investor. One area of financials that has performed really well and that we do incorporate into, our quantitative approach has been insurance companies. So you have something like an Arch Capital Group, which is, best in class specialty insurer and reinsurer. And, the reason being they've displayed like exceptional and disciplined underwriting over, their 20 plus years in existence. And they generate really high ROIC. So, in the insurance world, like mid to high teens is actually really attractive. So it allows the company to kind of compound its book value while remaining, resilient through different insurance cycles. So we still like the insurance companies and think that's a great company and type of investment for anybody's portfolio.
Andrew, we'll leave it there. Thank you so much for being with us. Andrew Skatoff is founder, also the CIO at Bancreek Capital Advisors, joining from Los Angeles here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.